asking a big savings and investment question. How do you make your hard-earned money work harder for you without losing sleep?
If you've ever looked at your savings account and thought, my account doesn't even keep pace with inflation, how am I supposed to save enough for a house deposit or save for later life? How do I make my money actually work harder? Or maybe,
I don't understand the stock market. It just looks like chaos. If any of that sounds familiar, this episode is for you.
in a nutshell, the old adage, time is money, really does apply here. Right now, lots of easy access, no notice accounts pay interest that often doesn't keep up with rising prices. Over time, that quietly eats into your spending power and nudges savings towards notice accounts where you leave your money untouched for 3, 6 or 12 months or more. Then there are alternatives, national savings and investments products, fixed income savings, premium bonds, and of course, cash ISAs with lower limits after the budget.
Not using your ISA allowances each tax year is a wasted opportunity, especially if you are paying higher rate taxpayer. Because you are missing out on tax efficient growth on the money you were going to save anyway.
If you're looking to the longer term, that's where investing in a pot of company shares, loans to the government and corporate bonds comes in.
Hello and welcome to our Savings and Investing podcast. I am Vera, Marketing Director at Heathcote Financial Planning.
And I'm Steve, a chartered financial planner. I've been helping people invest and plan for their futures for more than 25 years. Through the dot-com boom and bust and the 2008 financial crisis, through Brexit, the COVID crash, you name it, I've probably experienced the peaks and troughs of those volatile investment markets.
So let's start right at the beginning. What is investing really? And why does everyone keep talking about risk?
Before we get going, let's start with a quick but very important risk warning. Nothing in this episode is personal advice. We're talking in general terms only. Investments can go down as well as up, and you may get back less than you put in. Tax rules and allowances can change, and how they affect you depends on your personal circumstances. If you're not sure what's right for you, please speak to a regulated financial advisor. We're here to help. You can contact us at heathcotefp.co.uk.
In plain English, please do not copy anything blindly from a podcast or YouTube, including us. Use this as education, then get proper help for your own situation. Before we dive into the big picture and risk basics, a quick favor.
If you like learning about money in normal English, hit subscribe and the like button so this reaches more people. And if you're in the UK and thinking about investing, sorting out your ISAs, reviewing your pensions, you'll find a link in the description. Book a chat with me and the team. Right then, with that out of the way, let's start the very beginning. Quick note before we get stuck into the detail.
At Heathcote Financial Planning, our whole job is helping you move from I hope it will be alright to genuine confidence and a plan for your future.
We're independent and chartered, which means we search the whole market and bring 25 plus years of experience to your corner. Whether it's investing, pensions, mortgages, or protecting your family or business, we build a plan around you, not around products.
If that sounds like the kind of support you have been missing, there is a link in the show notes where you can book a no obligation chat. Alright, Steve, let's start at the very top. First thing first, what is actually investing? Because a lot of people hear that word and imagine men in suits shouting at screens.
Yes, and in real life, it's normally just me at a desk with too much coffee and a lot of spreadsheets. But seriously, investing, simply put, is using your money to buy assets. Things like shares in companies, bonds, loans to governments, property or funds, with the aim of growing that money over time or generating an income from it. If you look back over history, through world wars, oil shocks, crashes and pandemics, investors who stayed on the course in well-diversified stock market investments have, over the long term, tended to do better than those who just sat in cash. It hasn't been a smooth journey, but there's been progress.
Okay, now let me give you the simple explanation. Investing is when you take money you have saved and give it a job.
Instead of your money just sitting in a bank account being lazy, it's out in the world working inside real businesses, buildings or governments, trying to make money for you, your future.
Exactly. And historically, over the long term, investing in the stock market has tended to do better than just leaving money sitting in cash. It's not guaranteed, of course, but that's the basic reason people invest rather than only save. So why does this matter for you?
Because if you don't invest at all and you just stay in cash, you're likely to fall behind over the long term. Prices go up, your money doesn't keep up with inflation, and future you end up with less freedom and fewer choices.
So what can you do about it?
First, understand that investing isn't just for rich people. Most UK pensions are already invested in markets. You're probably an investor already, even if you don't feel like one.
Second, start learning. Even small monthly amounts into sensible diversified fund can make a big difference over 20 to 30 years.
And finally, if you're nervous, get advice so you're not guessing. Saving is parking your money. Investing is putting it into work so it can potentially grow faster than inflation. But it comes with ups and downs, so you have to be prepared for. And of course, once we talk about ups and downs, naturally takes us to the next topic, risk.
Okay, so now we have said investing is basically giving your money a job. Let's talk about the scary part, risk. If you are thinking, I would love to invest, but I don't want to lose anything, stay with us. This is really the heart of the whole game.
Risk exists because the future is uncertain. Companies might earn more or less than expected. Economies can slow down, interest rates change, wars happen, pandemics hit. Think of the 1970s oil crisis, Black Wednesday in the 90s, 2008 banking crisis. Think of the COVID shock in 2020. None of those were on anyone's calendars years in advance. Because investors are taking on that uncertainty, markets need to offer a potential reward. That's your expected return.
So, super simple version.
If you want your money to grow more, you have to accept that it might wiggle around more on the way. No risk, no return.
Now, why should you care about that? Because if you think investing is a straight line up, the first big drop will freak you out and you might sell at the worst possible moment. That's exactly what happened to loads of people in 2008 and again in early 2020.
They bailed out near the bottom, then watched the recovery from the sidelines.
So, what should you do instead?
Expect ups and downs, that's normal, not a sign you chose wrong. Match your risk to your goals and your time horizon.
We will talk about that in a minute. And don't invest money you absolutely need in the next couple of months or years.
Risk is the price of admission for long-term returns. You need to understand it, respect it, but not be paralyzed by it. Now, once you're comfortable with the idea of risk, the next logical step is to look at where you actually put your money. The different buckets, pots it can live in.
So let's move on to those buckets, or in finance speak, asset classes. Steve, give us the grown-up version first.
The equities, shares which are ownership in companies, bonds which are loans to companies, and gilts which are loans to UK and overseas governments to fund everyday expenditure and infrastructure. Cash, money in the bank or savings account. Property is physical bricks and mortar, buildings or property funds, and then some more specialist things like commodities, raw materials, infrastructure, which is roads or bridges, schools and hospitals, or alternatives like private equity. Each behaves differently in terms of risk, reward, returns, and how it reacts to economic changes.
Let me simplify that. Think of creating a savings and investment plan for the medium to long term.
Firstly, shares are usually for the long term, ideally 5 years or more, where you put your money aside for a special occasion, a big holiday or retirement. Investors who place money in well-established companies may be rewarded with dividend income, which can be reinvested or taken as income. By contrast, growth companies rely more on future expectations of the business. Think of the performance of the Magnificent Seven US technology stocks over the past few years.
Secondly, bonds are typically more secure than shares, with less volatility and the potential to grow the pot steadily.
However, you need to be mindful of the issuing country's level of debt, currency exchange rates and inflation. But that's where we come in to guide you. In addition, national savings products such as premium bonds, fixed interest certificates and 30-day notice accounts can work well for rainy day or emergency money. They often sit alongside other investments to provide easy access to cash.
Furthermore, gilts are loans to a government. Using the bucket metaphor,
the number of leaks at the bucket represents government expenditure and how much that needs to be financed, which in turn can influence how attractive those gilts are to investors.
On the other hand, cash is very calm and stable.
However, it usually doesn't keep pace with inflation over the long term, which means the real value of your money can slowly be eroded.
Moving on to property, residential owner-occupied property is like a big, solid bucket.
It can be a powerful long-term asset, but it's harder to move quickly. In other words, it's less liquid than cash secured against the property. Then, if you have borrowing secured against the property, then interest rate fluctuations will ultimately determine the attractiveness when you come to sell.
Finally, commercial and buy-to-let property sit in more specialist markets with fewer buyers and sellers.
As a result, expertise and careful research matter even more when you're considering these types of investment. You need to spread the risk by diversifying in a way that fits your life.
So, why do you care?
Because how much you have in each pot largely decides how anxious your journey feels and how your future self will be extremely grateful for your younger self making sensible decisions in 10, 20, 30 years' time.
In practical terms, what can you do?
Check your pension or investments and see what you actually hold. Many platforms show a little pie chart of your asset mix. Check the charges which ultimately drain returns. Compound interest is significantly impacted by charges. If it's all in one thing, like one UK equity fund, that's a potential red flag because you need to diversify into different markets. Talk to somebody about diversification. Make sure the mix matches your age, your goals, and your attitude to risk. Asset classes are the building blocks of a portfolio. Get the assets right and you've already done a lot of the heavy lifting for your long-term outcomes. From there, the next question is, what kind of markets are these assets actually in?
That brings us on nicely to public versus private markets. So next up, let's talk about public versus private markets. This sounds very Wall Street, doesn't it?
It does, but it's simpler than it sounds. Public markets are companies whose shares you can buy on a stock market, such as the FTSE 100 on the London Stock Exchange. Think big household names. You can usually trade these daily. Private markets are businesses that aren't listed on stock exchange. Many small and mid-sized startup businesses are private. Access is more limited, often through specialist funds.
So, to put it in another way, public.
On the shop shelf, you can buy and sell most days.
Private.
Backstage, often only big investors or specialist funds can access these, and your money may be tied up for longer due to fewer operators in that market.
So, why does this matter for you?
Because some investments that sound exciting, like private equity or venture capital, may be harder to sell quicker and may be riskier and more complex. They often only suit more experienced or wealthy individuals.
So, for most people starting out, we focus on simple, diversified public market funds.
Like global or UK equity funds or bond funds.
We treat private investments as something you might consider later.
And only with professional advice. Public markets are your main playground as typical investors. Private markets can offer opportunities and tax advantages, but they come with extra complexity and risk. Now, once you're in those public markets, the next decision is how you invest. Do you try to beat the market or simply track it with an index fund? That's where active versus passive investments come in.
Okay, if you are still with us, well done. In a moment, we will talk about inflation, the silent thief that's quietly stealing from your money, from your savings. So don't go anywhere. But first, let's tackle this big choice, active versus passive investing.
Active investment is where a fund manager and his team tries to beat the market by picking certain shares or timing the market, looking at undervalued shares. Passive investing is where a fund simply tracks an index like the FTSE 100 or a global index, often as much low as fees. These index funds are also specialist sectors like investing in the top 20 semiconductor companies or oil and gas or medical advances funds.
So, to put that simply, active,
I am confident in my choices. I'll pick the best horses in the race.
passive,
I'll just back the whole race and I'll pay less for the privilege. Now, why do you care about this? Because every extra percentage in fees is money not going towards your future. Think of compounding interest. In the UK, it's now very common for people to have a core of low-cost passive funds and then maybe some active funds around the edges if they want.
practically, what can you do?
Check what you're paying. Look for the ongoing charges figure or fund fees. Ask yourself, am I actually getting value for this higher fee? Consider mixing low-cost index funds with any active funds you really believe in. Active versus passive isn't religion. It's a toolkit, but low costs and broad diversification are often a very sensible starting point. And speaking of sensible,
Let's now connect this to time.
because how long you invest for changes everything.
Let's move on to time horizons. This is not just about how old you are, it's really about when you need the money.
Exactly. Short term is anything up to 5 years. Medium term is 5 to 10 years, and long term is 10 years plus. The longer your time horizon, the more risk you can usually afford to take because you've got time to ride out market falls. If you look back, investors who stayed invested for 10 years plus, even through volatile, turbulent times, have historically been rewarded with positive returns more often than not.
Let's make that concrete. Imagine you are planning next year's house deposit.
Your money should be pretty safe, mostly cash. Kids, university in 12 years, that's long term. You can take more risk to beat inflation.
Your own retirement in 25 years, very long term. Ups and downs matter less than long-term growth.
But it will come by in a split second.
So, what would we usually advise you to do?
Match the investments to the goal. Money needed soon.
Lower risk.
Longer term goals, you can usually accept more volatility. Don't check long-term investments every day. Time is your friend in investing. The longer your horizon, the less scary short-term volatility needs to be. However, there's another force working against you over time, and that's inflation. So let's talk about that next.